One is that tax provision that permits you to exclude $250,000 of gain on the sale of the primary residence and $500 on the sale of the primary residence if you file a marriage bond and joint return with the spouse. That almost has more relevance for you in 1031. And as I've always said, if you deal with a seller or buyer that asks you about tax consequences, you're going to make a big mistake giving advice based on what you think, because there's a very good chance you're going to give them wrong information. An excellent chance you're going to give them wrong information. So there's nothing worse than me sitting with a client that just sold a house, and they come in and they have a certain expectation, and I say to them, where'd you get that information from? And they go, Nick Simopoulos told me. Well, it's a problem, right? Because, and it not only a problem, it could be a $100,000 problem, $200,000 problem. So it could be a big problem. It might not just be something small that we can deal with and overcome. And if they go to somebody else to do their taxes, that's how we wind up in litigation, and that's how we wind up with problems. We can't even mitigate or stop the problem, right? So the best thing to say is, I'm not really sure. I think that this is the case, but let me verify. We have a tax attorney in the office. Let me verify with them. And as you all know, I've never had an issue ever answering questions regarding the sale of a house. The only thing I ask is, sometimes I get a call like this. Hey, Evan, I have this family that's selling a house on 72nd Street. How much capital gains tax do they have to pay?
Great.
It's like, what am I supposed to do with that, right? I mean, I can't answer any questions with that. I need to know, is it a rental property? How much of the house are they renting? What do they pay for the house? Typically, you know that I say to you, if you really want to know what the deal is, I need a copy of the tax return. And sometimes they're not comfortable giving you a copy of the tax return, but they would feel more comfortable giving it to me. And I make myself available. You guys need for somebody to come in. They can come in, I'll sit, look at the tax return, and I'll give them an honest assessment of what I think the situation is. And you also know me well enough to say I'm not going to tell them that they're not going to owe any taxes if they are going to owe any taxes, because it's just not worth it. It's not worth playing with people, lying to people. It always comes back and becomes a problem. So I'm going to give them an honest assessment. I'll tell them what their options are, and then hopefully you get the listing. But the worst thing that you can do is give the information yourself. So before we get into this, I just want you to know politically, because we have an election coming up, and I don't want this to be a political conversation, because typically no matter what you say, half the people get really upset, and half the people not, and they agree with you. So this is not political, but in terms of taxes, just so you know, the Biden administration wants to get rid of 1031 transactions.
Oh.
They've made it very clear. They don't see the need for it. They don't have a lot of support even among the Democrats, but it's definitely on their agenda. And you can argue whether it's a good thing or a bad thing. I personally, not because I'm in the business, but I think it's a terrible thing. But it's on their agenda. The other thing that's on their agenda is they are almost definitely going to be increasing capital gain rates. So currently, as you know, at the federal level, because there's also state capital gains, but at the federal level, the amount that you pay is either 10%, 15%, or 20%. But the truth is that if you sell a house and you have a capital gain of 100, 200, 300, 400,000, you're going to be paying tax at the maximum capital gains rate of 20% at the federal level. They want to increase that to 46%.
Oh my God.
How much?
46.
46.
So that is their official position. That is their unofficial official position, right? They want to tax it almost higher than ordinary income tax rates. Because their attitude is only wealthy people, only successful people have capital gains. The average consumer doesn't, right? They don't own Apple stock, they don't own homes. And this is really, the capital gains rate is really something that benefits higher income taxpayers. Now that we also know is 100% not true. But that is the political agenda, for sure. That's just the way, if you were to speak to Ocasio-Cortez, she would argue to death that only wealthy people pay capital gains tax. So, but I do want to tell you that in addition to the 20% federal capital gains tax, there is a 3.7% Medicare tax, we call this the Obama Medicare tax.
So-
So the federal tax rate, the maximum capital gains rate is 23.7. And, understand, and I don't want to get into this discussion too deeply, but if it's a rental property and there was depreciation taken, we talked about this many times, every dollar of depreciation that was claimed on a rental property has to be added back to profit. That's added back to 25%, not 25% plus the 3.7% Medicare tax. So that tax could be close to 30. Bottom line is, at the federal level, you're going to be paying somewhere between, at the federal level only, 23.7 to 28.7%. Federal. Right?
23% to 28%?
That's correct, federal. And then, of course, if you have the privilege of selling the property in the state of New York, or if you live in the state of New York, you're looking at potentially another 8.7% federal, another 4-point-something% New York City, if you live in New York City. If you live outside of New York City and sell a property in New York City, you don't pay New York City tax, it's only a resident tax if you live here. But we're looking at, on big capital gains, you're probably looking at, as a New York State taxpayer, somewhere around 36.5% tax, federal tax. If the federal tax rate is increased, it'll be over 50%. And the problem with that is it paralyzes the markets. Because if you're selling a piece of property for $2 million and you're going to lose, and let's say you have a profit of $1 million, just as an example, and this is why 1031 exists to begin with. If you're selling for $2 million and you're going to have to pay $300,000, let's make a simple example. If you're selling for $1 million and you have to pay $300,000 in tax, very common situation today, you're not going to buy anything for $1 million again. You're only going to buy it for $700 because of the tax hit, the tax equity hit. And the whole point of 1031 is, if you're selling a property for $1 million, as long as you use the money and you reinvest for $1 million, we're not going to make you pay the taxes at this time, right? The tax doesn't disappear; it just gets deferred, right? So the policy issue for 1031 is it permits the economy to keep flowing. I can tell you that if you sold a building for $1 million and you had to pay a $300,000 tax, you would think twice. If you had to pay a $500,000 tax, you wouldn't sell. I can almost guarantee. Well, some people would sell, but most people would not. It would paralyze them. So 1031 permits the markets to flow, and certainly if you're selling a $50 million building as a company, you're not paying $18 million in taxes or $20 million in taxes. It's just, you're going to figure out some other way to monetize that property to generate income from it. So it just paralyzes the economy as it relates to real property, and it's not a good thing under any circumstances, economically speaking. Politically speaking, completely different story. So we'll see what happens. You should also know too, and I see this all the time when I look at tax returns, if you are really a full-time real estate person, like most of you are, it's not like you have jobs at McDonald's, you work 40 hours at McDonald's and you do real estate on weekends. Most of you are not that. But if you are a full-time real estate person and you do not have another full-time job or a part-time job, you are not subject to that 3.8% Medicare tax on the sale of real estate. I can't tell you how many tax returns I look at, big tax returns where the accountants assess the tax. It's just not, you're not subject to it. So there are benefits to being in the real estate business, and one of them is not having to pay that Medicare tax if you have a capital gain. But I can almost guarantee many of you that are active with buying and selling, I can almost guarantee that your accountants are taxing you in that 3.8% Medicare tax. And if that is the case, you try to come and talk to me because we can fix it. We can fix it at least for the last 3 years. All right, so that's just basically what's happening in taxation. We'll see what happens with the election. And based upon that, people will make decisions moving forward. So we'll talk about 1031 first. So 1031